So now we can go to the next speaker, Alex Booth from Kepler. Let me introduce Alex. So Alex Booth is the head of research at Kepler, the leading provider of data and analytics in the commodity markets. He is a energy industry veteran with over a decade of experience and specializes in fundamental research across crude products and gases. Alex, and that's how I know Alex, started his career as a market analyst at BP, covering multiple trading desks. 8 years later, he was appointed VP of Fundamental Oil Analytics at Citi. In this role, Alex led the fundamentals of buy-side research within Citi's European oil desk, worked closely with traders as well as large corporate and institutional clients. Since joining Kepler in 2018, Alex has been playing a key role in the development of Kepler's transparency products. More recently, he has taken the lead in the research team, which brings reputable insights to the commodity community by harnessing Kepler's considerable array of proprietary data. Okay, Alex, well, the stage is yours. Good luck.
Excellent. Thank you, Patrick, and also thank you to Eugene. As Patrick was referencing there, in my history of analytics within BP and Citi, we were always long-term clients of JBC, and it was always very interesting to hear what they had to say. Always very good insights. So as Patrick was saying, I now head up the research team within Kepler. If you aren't aware of Kepler as a company, we started out looking at cargo tracking in the LNG market before moving on into the broader liquid space. From there, we've progressed further kind of through the commodities value chain, and are also now looking at the global inventories piece, the kind of the onshore storage piece for crude. So which is where I come to speak to you today, basically. So the main kind of premise of the session today is to say, right, where are we 1 year on from the kind of the post-COVID shock in the global storage piece. It's worth bearing in mind that in the oil markets, we didn't just have to contend with the aftermath of COVID, but even in the run-up to that, or in the very outset of the pandemic kind of rollout, we had to deal with the price war and kind of market share battle that was set about essentially between the Saudis on the one side, Russia on the other, in essentially a disagreement with how to tackle the onset of US crude production, basically, and the rising crude production. So, I head up the research team. This is something that's grown up, kind of been built up over the course of the last year or so, to really take advantage of all of the data that we have available in the kind of in the Kepler universe, and that we sit on. This is the team as it stands now. We're kind of moving out into more of the kind of shipping related activities, as well as kind of all the other products that we cover within Kepler. So what we'll start off with is looking at the overall picture for both the global onshore crude storage piece and also the oil on water piece. So the chart that you see here, the blue area is Kepler's tracking of onshore crude storage. Now that is predominantly based on SAR data, so small aperture radar data from satellite imagery of floating roof tanks. This is an approach that's kind of fairly widely adopted across the industry now, in terms of being a reliable way to cover at a macro level what's happening in the oil storage picture. Now, obviously, as you're well aware, crude is not only stored in floating roof tanks. We're also looking at there's also the kind of fixed roof tank option, as well as underground storage caverns. Using the data that we have to hand because of all of our cargo tracking operations and because of how we are able to look at the kind of the commercial parties involved in the trades. We can also follow what's happening in the fixed roof or underground storage tanks as well. A couple of examples being, say, your commercial terminals in the Caribbean. There is no refinery operation connected. You just have storage tanks. We're able to look at the vessels coming and going from those locations, make assessments of how much crude is being kind of discharged and loaded on those vessels, and therefore have an assessment of how much crude is in that facility. Similarly, if we look at, say, Saldanha Bay in South Africa, there's a bit of an added complication in that there's refinery offtake, but what we're doing in that situation is making an assessment of the refinery run rates, any outages or so on. At the moment, it's relatively straightforward in that the refinery has unfortunately been closed since a fire on an attempted restart in February of last year after their annual maintenance. So that refinery is closed. Basically, we can look to see what's happening with all of the vessel movements, and certainly the case last year, moving into the facility. And then as we've come out of through the second half of last year and into this year, with stronger price action, cargo's then kind of leaving that facility and going across to actually be consumed in the rest of the market. So just an introduction there into how we're looking at that onshore data. So as you can see, from April, we saw a massive rise in onshore storage. We peaked at just over 3.7 billion barrels in July. And we saw a steady decrease from that high point through the second half of the year, with about 770,000 barrels a day of crude drawing through the second half of the year from onshore storage. Now, where it gets interesting and where there's a lot of particular interest in the market at the moment, and we'll kind of come to that later on, is the fact that this is essentially flatlining on a global basis. So we've seen this real slowdown since the start of January, essentially, in terms of the global storage draws. There are kind of various reasons as to kind of what's behind this. But this is kind of one of the key factors that the market as a whole, and particularly say OPEC, when they're going into their regular monthly meetings, are taking into account when they're assessing kind of what's actually happening in the market, how much they can ease, and so on. So that was the picture for the onshore environment. Now, it's still also worth noting that we're assessing our storage numbers as 200 million barrels higher than the kind of than those of going into 2020. So a kind of a considerable increase year on year. And as Eugene was referring to, the kind of the overall demand picture as well, it's projected by the IEA that kind of the first quarter of this year is going to end up with demand in the OECD region down 10% year on year. And even in non-OECD, where there has been significant recovery in the overall market, still down 2% year on year. So we have these massively elevated storage levels, but with far decreased demand numbers. So the days forward cover for the market as a whole is significantly higher, basically. So moving on to what we see in the orange line there, that is a metric that we track from the cargo side of things as opposed to the onshore storage side of things, which is looking at oil and water. If you've seen any of the work that we've put out before, we like to look at oil and water as a kind of a rapid metric of the state of the market at the time. Basically, you can look at floating storage. So essentially, once a crude cargo has loaded, it's moved to a certain part of the world, it's still unsold, or at least it's been kind of the economics have been locked in for it to basically sit somewhere for 6 months on the basis that the trader is going to be making a profit on that, and then they can release it to the market in a more favorable environment. that takes time to build, basically. Whereas if you're looking at oil on water, it doesn't matter if the cargo is sailing to a specific destination and will discharge immediately. It doesn't matter if it's slow steaming somewhere but unsold. It doesn't matter, say, that it loaded in the North Sea, ships out to Singapore, at which point it still goes in floating storage. We're still counting it as oil on the water because it's very, say, as kind of length in the market, sorry, because it's a very immediate metric to help us understand what's happening. And as you can see back in April, with the kind of massive increase in exports, essentially from Saudi, that oil on water metric increased very, very quickly. Now, what's kind of quite surprising and very interesting is the speed with which it also then came down. But ultimately, that was crude that was essentially just being onshored. So a lot of that crude that was being drawn down from on the water subsequently essentially went into storage and slowed down essentially the draw on land. So we actually got quite tight. The market was quite tight at the tail end of last year, kind of going through into December. But then the Chinese imports dropped considerably at year end, which meant that oil kind of on the crude cargoes were then essentially sat on the water through into January, and that's the big rise that you see into the new year. Now those have gradually drawn down, basically, so we're seeing a bit less pressure in the market at the moment. But as I say, I think that the key thing that we're concerned with, and that a lot of the market is concerned with at the moment, is how things are just really slowing down. That the draws that we have been experiencing just aren't there at the moment. As I say, we'll kind of come to why we think that's the case in subsequent slides. So if we move on to look at what we see, again, still in the global picture, but this time looking at essentially kind of where storage is located. The map that you see here kind of pulls together a few different bits and pieces at the same time, so I'll run through it to explain it. What we're showing here is the total size of capacity, onshore capacity for storing crude. That's essentially the size of the bubbles distributed across the key global regions, basically. Then we look into say, okay, how does that break down by available capacity for SPR facilities, the strategic petroleum reserves, versus non-SPR commercial, essentially commercial terminals and refinery operation facilities, refineries, basically. And we look to see, okay, what capacity is there remaining within the system? Now, unsurprisingly, given the US and China have the largest total capacity available, it's also worth bearing in mind that a significant percentage of that is driven by the presence of their SPR as well. So that makes up a large percentage of the total available capacity within those two systems, basically. But it's also worth bearing in mind that there is significant capacity distributed across the rest of Asia Pacific as well. So that still plays kind of quite a large part into the available storage this year. Now, we've basically seen this relatively tight picture in kind of South Asia, and that's kind of worth bearing in mind as well. And we'll on the next slide we'll look to address why that can be. But yeah, South Asia did import and has increased its total volumes through the course of the last year, but not by much on a kind of barrels basis, but quite a bit higher on a percentage basis. So we'll address that shortly. I think one of the reasons why we like to kind of look at this picture, and then in other instances we'll go down into a kind of a very installation specific level of granularity, is to say, okay, not such the case now, but if we go back to the summer, kind of July of last year, and we were seeing ever higher levels of storage in the US and in China. What we want to say is, okay, where does that available capacity sit? If I'm a trader sitting on excess crude, do I think I can unload a VLCC, 2 million barrels of crude into a location? Are they going to be able to readily absorb it? If we look at China as a good example here, at points last year, there were only 10 installations or so that had a remaining capacity of about 5 million barrels or more. Then what you saw was a good 20 plus, which had kind of 500,000 barrels to 1 million barrels spare capacity. So being able to fill that becomes kind of increasingly harder. So you know that you're going to have to target certain installations if you're looking for an outlet, or certain players who have access to these installations if you're looking for an outlet for significant quantities of excess crude. Now, as I say, that's not exactly the position that we're in today, but the ability to look at this kind of information makes a huge difference when the market is under pressure, basically. So if we move on to the next slide, we can see just how things have changed over the course of the year, and where we're seeing these inventories sit, basically. So I mentioned earlier that China has basically been able to absorb a huge quantity of barrels. They had both spare capacity on the commercial side, as Eugene was referring to, the big expansion of refineries across the region. That has added more tank capacity that needs filling as well, both kind of operational and then to a certain extent strategic. So they had the ability to absorb this crude. Similarly, the US could build the crude, but then actually, if we look on a year-on-year basis, hasn't really added that much because of subsequent drawdowns. And we can kind of say we can address that shortly. But the bottom line is, if we think that we're about 200 million barrels higher versus where we were coming into this year, if we look specifically at February versus February, month end February 20 versus 21, China has built 113 million barrels, or just under 14% year on year. It took advantage, quite frankly, it's a spectacular advantage of the incredibly low flat price environment that we saw last year. Some of the largest flows into China were from the US, where they had lifted significant quantities of crude from the spring, at the same time that you were seeing kind of this wonderful technical elements of negative WTI prices around what was happening in Cushing at the time and so on. Basically, Chinese buyers took spectacular opportunity, loaded up on crude, and then actually took quite a few months digesting that through into Q3, basically, just the speed with which they were absorbing these barrels, the amount of crude that was then sat in kind of in congestion in queues offshore China waiting to discharge was significant all the way through Q3. We were seeing times when on average it would normally take 4 to 5 days for a crude vessel to discharge into China. That was spiking up to kind of 15 days of wait time. So a very big impact on the market from that point. So yeah, China has bought these barrels, and we'll touch in the next slide about kind of what seems to be happening there at the moment. And I mentioned South Asia earlier, and this is very interesting. Again, you think South Asia, essentially we're talking about India here, large refining capacity, very significant domestic demand as well, big export refineries as well. You'd imagine, and kind of SPR capacity, you would imagine that they would have taken significant advantage again in a similar way to China to load up on crude. Now, in effect, it's a very limited system. So yes, we saw them build about 20 million barrels year on year, actually that's about 24% of the total capacity, like 24% build year on year. So a bigger increase on a percentage basis than China, but still not that great in the scheme of things in terms of taking advantage of low flat price when they've already stated that they want to increase their strategic petroleum reserves. The problem for India is that they just don't have the overall capacity. Essentially, the refining system is built on the basis that it is very well connected to Middle East suppliers, short haul crude. Why hold large kind of, or why have the inefficiencies, as it were, of a large inventory capacity when you aren't dependent on that, or there isn't as such of a risk to your security of supply as you would be if you were a refinery elsewhere in the world. That works well in a very strong crude environment when you have short haul voyages. Not so great if you're in a very weak kind of crude environment where the market is essentially paying you to store crude. So that was a bit of a loss there. What was quite interesting at the time when their inventory started to fill was there was discussion about India leasing capacity from the US in terms of their available SPR. There is spare capacity in the US. There was talk last year, obviously, of taking advantage, buying up the crude, supporting the market from the likes of President Trump. That didn't materialize. Essentially, they couldn't raise the funds to fund those purchases. So there is still capacity in the SPR in the US. It remains to be seen if India is able to kind of to take advantage of that going forwards, basically. So I think the key thing that we'll address later on as well is what do we think is going to be happening now is, well, we are in a weaker environment at the moment. We're coming into a period of refinery maintenance. We're in this period of kind of shoulder demand, weaker kind of shoulder demand season. You've left the winter heat. We're essentially leaving the winter heating season, but we're not yet into the summer driving season. It's generally a bit of a lull in the market. And then we're also seeing these gradual increases in production from OPEC. So in terms of the picture of what we think is going to be happening going forward, we think that essentially there's going to be continued weakness and this move from essentially flat inventories to building inventories in the near term at least. So if we move on, I mentioned how we'll kind of address what's going on specifically in China at the moment. The chart that you see here looks at the distribution of storage in China by SPR and non-SPR. So SPR is the kind of the dark blue line that you see. Non-SPR is the lighter blue line. That's the kind of the absolute number on the top section of the chart. And then you can see the year-on-year changes in the chart below, and that's running through to the end of February. And what you can see is this gradual build in SPR over time, very kind of slow and steady build. It picked up slightly in the spring of last year, and then it's basically flatlined, and all of the kind of the activity has been much more in the commercial facilities, which is what you would expect by and large. There's kind of much more active traded environment in China at the moment, or kind of, and certainly burgeoning going forward. So it's worth kind of bearing in mind with the SPR facilities in China as well. A lot of these, as I was mentioning earlier, are the kind of the underground storage caverns. This is where we, in a traditional method of tracking onshore storage, you come unstuck. It's very hard to see what's going on. But because of our cargo tracking activity and the fact that we're monitoring all of the crude flows kind of into China, products coming out, etc., we're seeing the kind of the documentation from the ports, the agents, inspectors, etc., that give us an indication as to where this crude's going. You'll often have shared facilities where you will have an import terminal, like an import terminal for both a refinery and the government SPR facility essentially next door. But what we can do is look back at the paperwork and says, right, okay, this cargo is going to the refinery. but this cargo is being bought by kind of Chinese state going into the SPR. So that's kind of just a reminder of how we can look at the differences between SPR versus non-SPR as well. Now, as you can see from the kind of the line chart at the top and the light blue line, non-SPR builds kind of peaked in the summer of last year, back in September. That aligns with September, October. That aligns with the final kind of onshoring of all of the American crude that was essentially bought back in the spring. And there's been a bit of a decline since. What's concerning now is how that has turned around through February, and essentially it's continued on into March as well. So we're seeing this slow but steady build of onshore crude in China. Now, the question is essentially around this: why are we seeing this build? China specifically is a lot to do with Iran and the availability of Iranian cargoes. This is something that we've been looking at a lot in the last couple of weeks, because it's becoming ever more apparent that more and more crude is managing to make its way into Iran. From a cargo tracking point of view, it gives us a particular headache because the activities are often masked. Vessels will turn off their AIS transponders. That's one of the primary means that we can actually see what's moving from point A to point B. It doesn't tell us what's on, but at least we can see where the vessels are coming and going from. Those AIS transponders are being turned off. They are being activated to look like they're loading in Iraq. The most recent case is a lot of spoofing of vessels to indicate that they're loading in Oman, whereby they will transfer the kit, the actual AIS kind of kit, over to a smaller pleasure craft or a fishing boat, for example, which will sit off the coast of Oman next to the VLCC loading points. And then the VLCC that has actually come and loaded in Iran will kind of take its transceiver back, hook everything back on, and it's magically loaded its cargo from Oman. That's just one of the instances of what we've seen and been investigating in the last week or so. But if we put all of this together, there's a lot of crude arriving in China at the moment. That's also flowing through into very much reduced buying activities for other crudes. So the demand is there for crude oil. It's just being met by essentially kind of off-market, as it were, Iranian barrels. And so why does this matter in the bigger scheme of things, of how we think things are changing at the moment? Ultimately, the reason why we've seen, or why draws have been possible in the global crude market through the second half of last year, isn't really driven by demand. Yes, we are seeing improvements in certain places, but that isn't the kind of the main significant driver as to what's happening here. We can look at the next slide, which is looking at the products picture. But the chart here shows the top section, which is the OPEC plus exports, kind of on an absolute basis, and you can see that huge drop into May of last year after a spike in April. And the section, the chart on the bottom shows the cumulative changes since October of 2018, which is when the last big kind of OPEC plus agreement was made, or the OPEC plus agreement was made to try and restrict production. And what you can see is that if it hadn't have been for Iran for the kind of the last couple of years and their involuntary cuts, the market wouldn't have made any changes. OPEC plus wouldn't have reduced supply in the slightest, all the way through to April. Now, it was doing well up until May of last year, but then that fling around into April just really put a shock into the market that then had to be addressed. I think what's staggering is just how quickly that did turn around, basically. So the swing from the April oversupply into this huge cut in May was truly staggering. What you can see, though, is despite the fact that in theory there hadn't been any relaxation of levels or cut agreements through the second half of last year, the amount of volume coming from OPEC Plus was gradually increasing month by month by month, essentially. Now they managed to restrict that back again in January, but the data for February was still showing an increase again. Now the risk here is that we just continue to tick up higher, basically. And yes, OPEC Plus have agreed to cut supply to the market further and for longer than expected. But with crude prices where they are, there's a very strong incentive for people to cheat. And just finish off looking at the demand piece here as well. This chart is looking at the total clean product exports for like on a global basis. What you see is this significant drop and kind of as the market responds to the oversupply that was already building. So we're already seeing length in the market appear on the water in kind of March and April. And then finally that hit essentially the refinery margins, the export margins, to see that cut off in May. That's gradually been increasing, but we've seen a real increase over the course of the last 3 months. The concern is though that the clean product on the water, so the metric that I was talking about with regards to crude earlier, is already starting to turn higher. So it's implying that that demand or that increase in exports is essentially starting to overrun itself, and that the real outright demand isn't quite there in the market. So with that, I'll hand back to Patrick, and then so we can run through any questions that we have.
Okay. Okay. Well, thanks, Alex.